Hi, everybody. I hope you watched my first video and it left you on the edge of your seat waiting for more. If you didn't watch, why? Uh, Dude, just go do it. All right, just go watch. You won't be disappointed, I promise. And as your punishment for not watching, I want you to like it, subscribe to my channel, and then share it. You gotta be punished for not watching. Sorry. If you did watch it, thank you very much. I appreciate it very much. But I'm also going to ask you guys to like it, to subscribe to my channel, and then to share it. It's just, unfortunately, I'm just trying to grow this thing. So I need everybody to be full on participation mode. Thank you guys. Thank you so much. All right. So now that that's all settled, let's jump into today's topic. We are getting prepared to buy a house. It's exciting and frightening all at the same time, but hopefully with the right guide, you will be fully prepared. So step one into being prepared is to talk to a financial consultant, a mortgage loan officer. If you work with a local bank or credit union, a professional there that will be able to help you out. Every person's circumstances are different. And so that's why it's important to talk to somebody who is going to guide you on your journey, who's going to find the perfect product for you, the right product for you, and not just some cookie cutter thing that they're throwing everybody into and hoping it sticks. So find the right person. If you need help, I do work with a few different people in that department who I trust. Anybody that I recommend, I feel like I put my own reputation on the line for them. So I definitely want to vet them out first. So without further ado, let's get into it. In my mind, I believe there are 5 basic types of mortgage loans for home buyers. And then within those, there are going to be some subtypes and different products and things like that that lenders will lend. But the 5 basic types are going to be conventional, government insured, jumbo, fixed rate, and adjustable rate. And then, like I mentioned before, other companies and different financial people will have different products that they kind of associate under that. So let's start with conventional mortgages. The pros, they can be used for primary homes, secondary homes, or investment properties. The overall borrowing cost tends to be a little bit lower than other types of mortgages, even if the interest rates sometimes can be slightly higher. And some banks can hold the mortgage what's known as in-house, which means they can be a little bit more lenient with some of the guidelines if they want to assume that risk. The cons, minimum FICO score of 620 or higher is often required. You must have a debt to income ratio of 45 to 50%, and you'll likely need 20% of the sales price for a down payment. So if we go back to that in-house, so let's say, for example, you have a minimum FICO score of 619. Maybe the lender, if everything else is good, maybe they'd want to take that risk on and either charge you higher fees or a higher interest rate. Or let's say you have a stellar score of 780 or higher, but your debt to income is 51%. So maybe the lender would want to take that risk because they feel that whatever the circumstance, whatever the situation was, you would be a good risk. But it wouldn't go conventional mortgage. So they do have that option to hold it in-house. But you do need that higher down payment as the 20%. The next one is going to be the government insured mortgages. The pros and cons of these. The pros, they can help you get the financing when you don't qualify for a conventional loan. The credit requirements are a little bit more relaxed. A smaller down payment is required. And they're open to repeat and first-time home buyers. So it's not a one and done type of program. So as far as the credit requirements go, instead of needing a minimum of 620, you would need a minimum of 580. Some lenders will even go down to 500 if you put more money down. But a typical down payment required for the government insured mortgages for an FHA mortgage would be 3.5%. And the cons, many of these loans have mandatory mortgage insurance premiums that cannot be canceled. You could have higher overall borrowing costs, and you may have to provide more documentation to prove the eligibility for these loans. So there's three types of government insured mortgages, FHA, USDA, and VA. The FHA loans that I mentioned before, they have that 3.5% down option with a minimum score of 580. The USDA loans, they do have more restrictions as far as geographic location or income limits may be concerned. So maybe you're looking at a place that does offer a USDA loan, but your income is too high. Or maybe you're looking at a place that doesn't offer it, but your income falls within the guidelines. You have to meet both of those. So your income has to be under a certain amount, and it has to be a certain location where it's offered. The other one, the VA loan, these are military loans, either active or retired veterans and their families. They don't require a down payment or private mortgage insurance, the mandatory mortgage insurance that we mentioned in the cons. They don't require either of those. So it's kind of the best of the three. You kind of get your most bang for your buck for the three government insured loans through the VA. But again, only certain people can qualify for those. The next one is a jumbo mortgage. These are anything that doesn't conform to the secondary market over that minimum threshold, which for 2021, the loan limit is $548,250. Or in other higher cost areas, that amount is $522,375. So if your loan is over that amount, then it would be considered a jumbo mortgage. And it's not based off of the asking price of the home you're going to get. It's just strictly based off of the loan. So if you're looking at a $900,000 house and you need to get $600,000 in a mortgage and you're going to put $300,000 down, that would be a jumbo mortgage that you would be getting. If you're looking at that same $900,000 house and you're going to put $500,000 down and you're only going to get a mortgage for $400,000, you would not need a jumbo mortgage. So that's the difference. It's not the asking price that matters. It's the amount financed that matters. So the pros of this jumbo mortgage, you can borrow more money to buy a home in an expensive area, and interest rates tend to be competitive with other conventional loans. Some of the cons, a down payment of at least 10 to 20% is needed. So you will need a higher percent. Again, 10 to 20% of a $900,000 mortgage is a lot more than 10 to 20% of a $200,000 mortgage. You'll need a FICO score of 700 or higher. You cannot have a debt to income ratio above 45%, and you must show significant liquid assets. So typically 10% of the loan amount, either in a cash or a savings account, not I have real estate that's valued over 3 million. It doesn't matter. Liquid assets. The next type of mortgage are fixed rate mortgages. These are the most common types of mortgage because these are just the broad range of spectrum. As soon as you sign on the dotted line, if you sign saying you're being offered 3.5%, that 3.5% is going to stay with the life of that mortgage. The only time it would ever change is if you decide to refinance. Otherwise, you sign the papers at 3.5, it's going to stay at 3.5. So the pros of this is your monthly principal and interest payments are going to stay the same throughout the life of the loan, and you can better budget for your other monthly expenses. The cons, you generally pay more in interest with a longer term loan. It takes longer to build equity in your house, and interest rates are a little bit higher than they would be on adjustable rate mortgage, which brings us to our adjustable rate mortgages. The pros of this is you'll enjoy a lower fixed rate than in the first few years of your home ownership, and you'll save a substantial amount of money on your interest payments. The cons, your monthly mortgage payment could become unaffordable resulting in a loan default. And home values could fall in a few years, making it harder to refinance or sell your home before the loan resets. Adjustable rate mortgages are typically called ARMs, ARM, adjustable rate mortgage. So that's kind of the acronym used for ARMs. And think back to 2008 when the housing market collapsed. A lot of those were because of these adjustable rate mortgages, because people were signing things they didn't understand. They thought, oh, this monthly mortgage payment's only $700 a month. Oh, this is great. I can afford that. And then all of a sudden, when the rate adjusted and the rate changed, the payments went to $1,200, $1,400, $1,500, double, tripled in some cases. And they all of a sudden, they couldn't afford that. And so what they would try to do to afford that was refinance or sell it. Unfortunately, the house wasn't worth it because they were paying so low interest. They weren't building the equity. And so they weren't able to do that. Now, as I say this, I want you to understand adjustable rate mortgages are not the evil devil of the mortgage world. They can be very good in some situations for certain borrowers. So they are not the sole reason for the mortgage collapse. They were a tool used in the mortgage collapse. Please, please, please know the difference. There are certain products that are best for certain people that could absolutely benefit one person and absolutely destroy another person. So please do not think that adjustable rate mortgages are these evil swear word type of mortgages. Thank you guys for tuning in today. I know it was a little bit longer than 10 minutes, but it was just a little bit longer. So I appreciate you guys sticking it out those extra couple minutes. But in all seriousness, being prepared is the best thing, most important thing that you can do, especially in today's market as a buyer. So remember, not only do you need to do all this research yourself and just make sure that you know what you're getting yourself into, but also find a trusted mortgage person, loan officer, who will have your best interest in mind and not just their bottom line and their salary. Thank you, and join me next time. I will dive a little bit deeper into each one of those specific mortgages that I mentioned. Thank you, guys. Don't forget to like, submit, share, comment, paste, copy, whatever you got to do. Spread the word. Control, Alt, Delete, whatever. I don't care. Just do it. Please spread the word. Get the word out there. Thank you, guys.